Yield to maturity is the total return that's expected if a bond is held until maturity. Now, this is calculated as a long-term bond yield, but it is expressed as an annual percentage. It is the internal rate of return made in a bond if an investor holds it until maturity.
Let me simplify. Internal rate of return is nothing but the return you make on an investment, which is a little more complex than the usual ones, where there's a cash flow coming to you just like a bond on a recurring basis.
So Firoz, in this case, how is it different from a coupon then?
Yes, Sumaira, I think quite a few seasoned investors are also a little confused because debt has not been a very mature market for India. Coupons and yields are different because if you buy something in the primary market, you are only concerned about the coupon because you're going to hold that till maturity, for example. Yield comes into picture when you buy a bond at a price different than the face value of the bond. Let's take an example to understand this logic. For example, a bond has a face value of 100 rupees with a coupon of 8% and the tenure of this bond is 10 years. Which in effect means that you get a coupon of 8 rupees for having bought this bond on a yearly basis. If in the secondary market, a person buys it at a price of 90 rupees, which is a discount of 10 rupees to face value, the IRR or the yield to maturity will be greater than 8%, which is the coupon, because of this additional discount which a person has received. In turn, in 10-year periods, the internal rate of return, also called as yield to maturity in this case of a bond, is 9.14%.
Okay, let me play the devil's advocate then. Why shouldn't the fund manager be looking at this? Why should a debt fund investor bother about it?
The debt fund investor may not want to be concerned of the individual bonds in the debt fund, but finding out the YTM or yield to maturity of the overall portfolio is nothing but finding out the interest expected on the basket of those bonds. It's as important like when we buy a fixed deposit, we definitely are sensitive to the interest which the fixed deposit pays. Point 2, when you're looking at YTM, which is yield to maturity of a bond fund, it's also important to find out the net YTM, which implies that from the YTM, you remove the expenses of the fund manager to manage that money and then you get the net yield to maturity.
Well, I'll yield to that wisdom. When you're thinking of long-term wealth creation, sometimes timing your exit is as important as the very investment that you're making.
You're right, Sumaira. Actually, exits are as important as purchases because what goes up also comes down. So you have to identify when to quit the game.